momentum behind us, and tomorrow we're going to get the first major rate cut. Jeff Kleintop joins us, Chief Global Investment Strategist. Great to have you here again today, Jeff. So tomorrow we're all set to go for the ECB to slash rates?
Yeah, we are. The interest rate futures market's pricing in a 99.8% odds of a rate cut of 25 basis points by the ECB tomorrow. I always get a little nervous when the market is that confident in any outcome, but they've certainly confirmed that both at the top of the ECB with President Lagarde and many of the other speakers. So the real issue is whether they signal that they're going to skip a meeting in July or pause and maybe not go again till September. September makes more sense to me because they'll be able to judge whether inflation remains on track. They're going to get updated ECB projections and a lot more data by then. What's interesting is the market's already started to move as if a rate cut cycle is underway. Here in the second quarter, we're seeing small cap stocks in Europe benefit. Unlike in the US, where the Fed's expected to keep rates steady and small caps are underperforming, in Europe, smaller companies, which are more credit sensitive, they borrow a lot more, they're very interest rate sensitive. They've been outperforming large caps in the second quarter by nearly 4 percentage points. So already investors factoring in a series of rate cuts from the ECB.
Yeah, that's where I do wonder if maybe the timing of all this risk on the day does somewhat overlap, even if it might not apply directly. The notion that you've now got multiple cuts, Bank of Canada first, ECB next. I mean, Bank of Canada, though, ECB carries a little bit more weight. But to your point, I mean, it's not obvious if it's a cycle, right? Like, we need to maybe take it one step at a time.
Look, everyone's very data dependent right now. I mean, I would say that the Bank of Canada today, when it cut rates, said it's reasonable to expect further cuts, but it didn't say when or how many. So, I mean, they're giving a nod that, yeah, it's probably the start of a series. But look, very few central bankers are expected to go in a row, right? And usually that's what happens. In fact, every time we've seen rate cuts over the last 30 years or so, the first few have been in a row. And that's not the expectation this time. It just shows how data focused and sensitive this data is. So clearly, if we get some upside surprises on inflation, if there are other developments that take place, maybe we see a further ramp up in some of the data like we saw today with the ISM Services Index, that could put a hold on some of those expectations.
Okay. Let's talk Bank of Japan here and the yen. Some interesting moves there. This was a real hot topic last month and kind of earlier this year, sort of fizzled out, I guess, because the other central banks are now making moves too. But what are you watching there?
So, I think the move today was more about what was going on in the U.S. than in Japan. But I think the next rate hike by the Bank of Japan is probably in October. And if anything, that firmed up in my estimation today because of the latest wage data. We got the April wage data in Japan, very strong numbers, strongest numbers in I don't even know how long, more than a decade. So really seeing a ramp up in wages. That's, of course, a precursor to getting more consumer spending, more demand, and therefore a sustainable level of inflation around 2% in Japan. That's looking more likely than it has in a very long time. That keeps them on that path of slowly, modestly hiking interest rates. And of course, they're talking a little bit about how much QE they're going to do, how much they need to slow that down to keep their yield curve upward sloping. But that's that backdrop. What we've seen over the last month here is the yen has kind of stabilized a little bit versus the dollar. So we'll see whether that's sustained as we go through the summer.
Okay. The global data, as we got ISM's PMIs, how's that looking, Jeff?
Yeah, it's looking great. So we got a 50.9 on the global manufacturing PMI. That's the strongest number in 22 months. So that manufacturing recovery is intact. And one of my biggest worries this year is as manufacturing recovered, that was my forecast, that services would slow. I didn't expect a recession, but I was worried about it. That doesn't appear to be the case. Services seem to be holding up around the world at various rates, right? In the US, maybe a little bit stronger than what we're seeing in Europe, but across the board, services continue to be expansion territory and now joined by manufacturing. That's really good news for profits. And one of the reasons why we were seeing upward revisions to earnings estimates, that's another support for the market here lately.
All right. Great stuff. Jeff Kleintop, nice work there. Bang, bang, bang. A lot of information. Appreciate it very much. Very helpful for us.